Today we'll be analyzing the Campbell's Company. I'm Allie.
I'm Natalie.
I'm Ashley.
And I'm Dawson, and I'll walk us through our introduction. All right, Campbell's Company. The Campbell's Company is listed on the NASDAQ exchange with the CPB ticker symbol. Its industry is consumer staples with a focus on providing affordable food and beverages. It's split into two separate divisions, snacks and meals and beverages. Its primary market is located in North America, which is Canada and the United States. All right. Leadership and Board of Directors. The chairman of the board is Keith McLaughlin, who's got experience in many different industries, such as DuPont, and was a West Point graduate. Mick Bakehausen is the president and CEO of Campbell's. All right. Industry peers and competitors. It's Campbell's largest competitor and most direct competitor would be General Mills. General Mills has a focus on breakfast foods and cereals, which is in direct competition with Campbell's snack department. Kraft Heinz is also another major competitor, especially in the condiments and packaged food industry. Hormel is a direct competitor in canned foods and food service distribution. Some other competitors are Tyson Foods and U.S. Foods Holding Corp. Economics and key issues. Campbell's is a consumer staple, which means it's defensive and non-cyclical. The key issues to Campbell's specifically would be input costs, packaging, and transportation, and competition. Key issues to the industry of consumer staples as a whole would be changing consumer demand, inflation, supply chain disruptions, and the overall economic environment, as can be shown with the graphs with revenue and free cash flow. 52-week high and low. The high has been $42 and the low has been $26. The stock is down 37% over the past year. This means it's trading below both its 50-day and 200-day moving averages. This bearish trend throughout the year has left Campbell's with a very poor stock performance. So decision, should investors put their money in Campbell's? Well, if we were to look at the past history, generally we should not, but it's more complex with this, and we'll come back to it at the end.
All right, so today I'm going to be talking about the financial ratios between General Mills and Campbell's Company. So for profitability, General Mills is running a more efficient and financially stronger core business than Campbell's. They have a higher operating margin and an overall better cash conversion ratio. For management effectiveness, General Mills is using its assets and shareholders' money much more effectively and consistently than Campbell's Company. Their return on equity and return on assets is almost double that of Campbell's Company. And for the financial strength, General Mills appears financially stronger and more flexible, while Campbell's carries higher leverage and therefore higher financial risk. For efficiency, Campbell's may generate slightly more sales per worker, but General Mills is much better at turning those sales into profit and running operations efficiently. This is through their higher inventory turnover. For valuation, both companies are trading at valuations below their 5-year averages, which suggests that they may be undervalued compared to their historical levels. This is shown in their lower price to earnings ratio. And then for overall growth rates, the industry is growing very slowly, and neither company is currently showing strong earnings in their momentum.
Now we'll be going over the financial analysis. Campbell's revenue grew 21% over the past 5 years, reaching around $10.25 billion in 2025. But the organic sales actually dropped 1%. So the growth is really only coming from our Rouse acquisition, not the core business itself. Also, the net income dropped around 40%. So the money that they're bringing in more money and keeping way less of it. Now, if we look at our strength and weaknesses, On the strength side, our EBIT margin is around 11%, which actually beats General Mills by around 6.8%. So operationally, we're running well. We also have a strong cash flow of 1.1 billion, which covers both debt and dividends. And that's mainly because Rouse has been our biggest brand. But our weaknesses is that our debt to equity is 1.85 times more, which is way above the industry's average of 0.71 times. And our biggest weakness is that our snack segment isn't as strong as other competitors and that our stock has been going down in the past year by 37%. But if we look at our strategic recommendations, our first one is our biggest, which is to pay down our debt because that's our biggest liability right now. Our leverage ratio is way too high, and our free cash flow needs to go towards bringing that down. Our second fix is that we need to improve our snack segments, probably through marketing and new product development. Our third one is that we need to protect our Rouse brand because that's our biggest income. And our fourth is that we need to hit 375 million in cost savings target by 2026.
Sustainability and ESG. Campbell's is a very sustainable company. Its ESG rating is 4.2 out of 5. This reflects strong sustainability and ethical practices, especially in its industry. It's competitive with top global peers like Nestle and outperforms the subsector and country averages. That can be demonstrated clearly on the slide where it's outperforming in almost every area. It has a much higher ESG rating than General Mills at 3.5. That can be shown on the next slide. The top graph shows that Campbell's competes well with its peers in its ESG rating, while the bottom graph demonstrates that General Mills underperforms all of its peers in almost every area.
Next, going into stock performance analysis. First, looking at our 52-week percent return, we can see that Campbell's company had a negative 42.59%, which shows significant decline in value. Comparing this to the S&P 500, which returned about a 21.38%, shows Campbell's dramatically underperforming compared to the overall market. Now looking at Campbell's beta, we can see that they have a negative 0.05, which shows how strong Campbell's company is in their market. They have extremely low volatility, which is similar to their competitors, just because the consumer staple sector is such a stable sector. Next, looking at the risks, the main three risks are competition in the market, consumer preferences shifting towards more organic companies, and then also input costs and ingredients and materials. Lastly, looking at the capital budget projects, the two main projects we focus more on the acquisition of the Sovos brand in 2024. They acquired Sovos for $2.7 billion. And as we said earlier, it was one of the smartest decisions they could have done because they got the Rouse pasta sauce, which is a new premium packaged foods market that they invested in. And also in 2026, they invested in supply chain modernization with about $230 million to upgrade manufacturing facilities and improve operation efficiency.
Okay, so our concluding thoughts. We said before that it was a more complex decision than just on the face. The stock is underperformed, but this means that its dividend yield has increased at the current stock price. It's a defensive stock. It's not a growth stock. So for investors looking for an income yield, this could be a good stock with a 7% dividend yield, but it's not going to be a growth stock, and it's not going to give returns like tech or any other stocks. And that is our analysis of the Campbell's companies.
Thank you.
Thank you.